Good afternoon, my name is Chung Leong. I'm a dealer for the Phillip Futures Forex desk. For today's market watch, I would like to do an analysis on the USD post non-farm payrolls. Non-farm payrolls is an important statistic which has a huge impact on the FX market, especially on the US dollar. For this market watch, I would also like to analyze the Japanese yen together with the US dollar, as there is currently a divergence in economic policies between these two economies. Recently, US have posted solid economic data, and based on these economic releases, we are bullish on the US dollar. On the 3rd of October, the US non-farm payrolls came in higher than expected at 248,000. This shows that the US is on a strong path to recovery as the nation added more than 200,000 jobs in the month of October. Unemployment rate also fell below 6%. Also, on the 17th of September, the Fed raised the median Fed fund rate projection by 25 basis points. Hence, this reinforces our view that interest rate hike will be brought forward. This view is reinforced with the US also posting better housing numbers and manufacturing purchasing managers index. These positive economic numbers led to a dollar buying across the board. Let's have a look at the dollar index daily chart, DXY. The dollar index, DXY, is an index measure of the US dollar values against a basket of currencies such as Euro, Yen, Sterling, Canadian dollars, and the Swedish krona, including the Swiss franc. From the chart, you can see that the dollar is on an uptrend since the month of June. It rallied to the highs of 86.75 in September. These highs have not been seen since 2010. Other factors that contributed to this sell-off are the IMF global downgrade, where IMF downgraded the global growth of 4% in 2015 to 3.8%. The Fed also expressed concerns on the US dollar strength, as they fear it may harm US recovery in midst of the IMF downgrade. However, we still believe the midterm bullish trend in the US dollar is still intact. You can see that the DXY is still trading above its major moving averages, the 50 and the 200 moving averages. I believe that we can take advantage of the US dollar strength by buying the US dollar and selling the Japanese yen, as there's a divergence between these two economies. On one hand, US is preparing for a rate hike, and on the other hand, Bank of Japan is implementing quantitative and qualitative easing, QQE, to weaken its currency. Based on these two facts, we like to long the dollars and short the yen. There are also a couple of reasons that we think the yen will weaken further. Number one, Bank of Japan is still far from its 2% inflation target. Currently, Japan's inflation, excluding the GST effects, is at 1.1%. Investors in Japan are diversifying into foreign securities such as shares, bonds. Local investors have to sell the yen to do so. In September itself, 400 billion yen of foreign shares were bought, highest since 2009. US securities and treasuries are likely candidates as well, as they offer higher yields and the US economy is recovering, which is beneficial for the US stock market. Let's look at the daily chart for the dollar yen. We can see there's some profit taking in the dollar yen as it tried to breach 110 levels over here. We prefer to buy on the dips rather than chase the markets. As you can see, if we draw a Fibonacci line from the bottom at July 2014 up to September, there are supports coming in at a Fibonacci 38.2% at the 106.65 levels. Next support coming in at 50% of the Fibonacci level at 105.59 levels. We still believe that the long midterm trend for dollar yen moving up is still intact, as it's still trading above its 550 and 200 moving day averages, as you can see from the blue line and the pink line over here. Let's have a look at the dollar yen weekly chart. 110 levels, which is this level, represents a very strong resistance, as this is the highest not seen since 2008. We believe there's large sell orders and a lot of volatility around this level. But however, if the dollar yen managed to clear these large sell orders, it will target 112 levels. Let's look at how we can earn interest from the weakness of the Japanese yen. Another trade that we can actually take advantage of is the Aussie yen carry trade. Traders can take advantage of the Japanese weakness by selling the yen and buying Aussie. Interest can be earned as Aussie offers higher interest rates compared to the Japanese. Currently, the pair is trading within the channel, and levels to look out for to go long is between the 90.00 and 91.00 levels. Do take note, however, carry trades do not do well during high volatility conditions. Volatility can be measured by looking at the VIX index, which is the Chicago Board Options Exchange Market Volatility Index. A number above 20 in the index represents high volatility and carry trades are not favorable during these conditions. Let's look at the dollar-yen uptrend headwinds. There are several headwinds that dollar-yen uptrend will face because dollar-yen is a safe haven currency and investors will buy into the Japanese yen during geopolitical crisis. Currently, there are a few events that are causing jitterness in the markets such as Russia and Ukraine conflict, IMF global growth downgrade, and the Middle East crisis. BOJ as well have from time to time expressed concern on the rate of the yen depreciation as it hurts small businesses and households. However, the bigger picture remains intact. Buying dips is still recommended. For more information on the risks and returns of investing in futures markets, please approach any representative from Phillip Futures for further discussion. With that, I have come to the end of my presentation of Market Watch. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos. Thank you.